One of the most talked about topics in commercial real estate lately has been the concept of negative leverage. Negative leverage is when a property's borrowing rate exceeds its cap rate. And we've seen significant increases in interest rates for fixed and floating rate mortgages, but the big question right now is why underlying cap rates haven't expanded by a similar amount. For the purposes of this video, we're going to be talking about institutional Class A assets, which seem to be settling in the mid 4% range in a lot of markets across the Sun Belt. So that would imply that investors are currently taking on negative leverage to the tune of 2 to 3%, which is historically very high. Well, contrary to maybe a lot of what you're hearing out there, I'm going to present a few factors that could be keeping cap rates fairly compressed. The first is that many of these buyers are betting that multifamily rents are going to continue to rise. We've seen increases of 22% nationally and more than 40% in some Sunbelt markets since March of 2020. We've just recently had 3 consecutive months of declines in demand, which could be pointing to some normalization, but even still, most projections have rent growth anticipated to remain in the high single digits, which compared to a more normal rent growth would be closer to 3%. The second factor is the expectation by many investors that the Fed moves are going to end up breaking something in the markets, and then a period of quantitative easing would ensue, ultimately resulting in lower interest rates. So if that happens, then positive leverage would then return to the market, and some buyers may be simply just hoping that happens sooner than later. And I should also clarify who these buyers are too. These aren't small operators. Many of these buyers in the Class A institutional segment are long-term holders who can look past periods of market disruptions. Many of those investors believe that the long-term terminal or exit cap rates are going to eventually return to a more normal spread above the 10-year US Treasury yield, which has historically hovered closer to a 1.5 to 2% premium above the 10-year yield. So apart from the anticipation of future rent growth or the anticipation of future moves by the Fed, the other factor that may help keep cap rate expansion at bay is related to the amount of liquidity that's in the equity and debt markets. There's currently an estimated $350 billion that's been raised by closed-end private equity vehicles, with a lot of that earmarked for value-add and opportunistic investments that's been simply just waiting on the sidelines, waiting for signals of significant value declines. So with that much liquidity in the marketplace, there's a somewhat narrow limit on how far values can actually fall before reaching some sort of price stability. And if we think back to past periods of market disruptions, they've resulted from over-leveraging and fundamentally poor underwriting standards. Right now in the market, 88% of outstanding multifamily mortgage debt has been originated by government agency debt, banks, and life insurance companies, all of which have tightened their underwriting standards significantly since the Great Recession. So as a percentage of the overall debt market, only a very small minority were financed using high leverage short-term bridge financing, which ultimately limits the amount of leverage risk that's in the market. I'm not saying there isn't some out there right now. We may certainly see some untimely maturities, but there's a lot of happy capital that's ready to snatch us up when those investors start to feel the pinch. So to sort of bring all this back into perspective, yes, there are some wild moves happening in the capital markets right now, but a significant amount of multifamily owners just took advantage of very low fixed rate environment that we just had for the past 24 months. And on top of that, we saw historically high rent growth. So the distress in the market, the likes of which we saw in the 2008 crisis, it may not be in the cards for the near future. If these factors do help to keep cap rate expansion at bay, then that $350 billion in dry powder that's out there may have to just settle for some air being let out and letting the market normalize. We'll be sending out our annual multifamily market report very soon, so if you'd like to hear our take on everything from inflation to interest rates to supply and demand and many more factors impacting the multifamily market, make sure to join our mailing list on our website, and we'll see you on the next video.